For more detail on just how markets will react to Trump's administration, a little earlier I spoke with Kenny Polcari, the chief market strategist from SlateStone Wealth. He's a regular commentator on Fox Business and CNBC. I spoke with him from his home in Jupiter in Florida.
Well, my sense is that the markets are going to be very excited. Look, futures were screaming higher about a half an hour ago. They've backed off a little bit, but they're still elevated, right? Which should suggest that tomorrow's going to be, another up day unless something happens overnight. But I think they're reacting to what they saw today, right? The change of the handover of power, and then the speeches afterwards, and then tonight he was making signing all kinds of executive orders, trying to get rid of some of the stuff that Joe Biden instituted over the last couple of weeks, as well as pardoning many of the J6, the January 6th men and women.
So just an interesting thing here. If you think about what he's talked about drill, baby, drill, more oil and gas for America. He's talked about the fact that there could be tariffs on Mexico, on China, on Canada to protect American businesses. He's also talked about the IT revolution for the future that's coming, which is why so many of those tech billionaires were out there today at the inauguration. All of this is very much pro-American business. This is a reason why Americans, of course, and American investors are potentially going to love what Donald Trump brings.
Well, for sure, right? But this has been all part of the campaign, so people have been able to digest this and listen to it and prepare for it, right? So none of this is new news. What's going to be new is whether or not he actually is able to get it done, or if Congress somehow slows him down or gets in the way, right? He's already signed off on, drill, baby, drill, and bringing more oil, and we knew that. Bringing the price of energy down is going to be good across the whole economy, right? Because it'll bring down the cost of energy, it'll bring down the cost of production and the cost of transportation, and that should help inflation. So that would be perceived as good, and I think it will be good if he's able to do it. But the tax, extending the tax cut plan is going to be something that may run into some problems. Tariffs, I think, is really just him using that conversation as leverage on trade. I don't see that he's going to impose sweeping tariff regulations on anybody, but he is using it out there as a threat, and people on the other side seem to be responding. So that's good. There's nothing negative about that.
And the interesting side of that is because if there are broad tariffs, that obviously leads to higher prices for American consumers, which leads to inflation, which leads to not as many interest rate cuts, which markets, of course, don't like.
Well, so here's the deal, right? The market is still pricing in one, maybe two, certainly one in late spring, early summer, and maybe a second one in the fall. I'm in the camp that the economy is robust enough, the labor market is very strong, and inflation is starting to rear its ugly head again. So I'm in the camp that we don't get any rate cuts at all, and that the risk is actually to the upside, not to the downside in terms of the next move in rates. And that will be dependent upon whether or not inflation really starts to tick up and really starts to, creep up higher than where it is currently. And I think that's really the risk. Not because I think his programs are going to be inflationary, because it was expected to go up under either administration. But I just think that, there's going to be this new excitement about the economy, and that will probably initially cause some inflationary pressures. And I think that's going to keep the Fed on hold.
And of course, the market's already been on a heater with records for the NASDAQ, for the Dow, for the S&P 500. In Trump's first term, his first year saw an increase of 19.4% in the S&P 500. The question is whether that can be replicated given the run that the stock market's already had.
Well, and I agree. And look, the market's had, the S&P, the NASDAQ have been up high double digits, 25%, 30%, 2 years in a row. And so the sense is that while the markets, the expectation is for markets to be up, but they're probably more to a return to normal, somewhere in the 10 to 12 or 10 to 15% range, which, by the way, would still be good. But many people would look at that as a failure compared to what happened over the last 2 years, right? I mean, you have to kind of put it in perspective. I actually think the market's going to return to a more historical return, which would be the 10 to 12% range.
I'll tell you what, Kenny Polcari, always great to talk to you from Jupiter, Florida. I know it's late there. Many thanks for your time today.
You as well. Thank you very much. Happy New Year.